Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. It is Friday, so this is another Investment Friday episode with my dear friend and Chief Investment Officer, Brad Haines. How you doing, man?
Doing well. How are you?
I am good today. So we're recording this on Thursday, May 30th, and it is my youngest child's 9th birthday. So my third baby, she's in her last single digit year. Next year she'll be double digits. All the kids will be double digits. So it's
Well,
not
we're starting to
bittersweet.
age. Boy, starting to age. We're starting to
Right.
get up there.
All right. See some gray. If you're so actually, I think it's a lot. I have a lot of gray hair.
You know,
But
when I started in the business managing money, I I looked very, very young because I had dark hair and and I couldn't wait until I got a little gray hair, a little salt and pepper, because all the people that I saw doing really, really well in our business had salt and pepper hair. They'd been through the grind for a while. They'd been through market cycles, and so naturally clients trusted them more than, a young 25-year-old kid that looks like he just graduated from high school. It becomes
I same. I was 23 when I started in the business, and the same all the way. I mean, I really didn't start getting gray until just the last couple of years, and even like at 35, people are like, how long have you even been doing this? And at that time, it was 12 years. They're like, no. They still like, if you look like you're in your 20s for any reason, people are still like, not sure about that. So yeah,
yeah.
I've not dyed my hair. It was same. Like, it's like the gray, like you need the gray so that people trust you more, which I'm sure that's not actually true, but having like, I tend to look younger than I am anyway. Like I'll keep it there just so leave it
Hey,
be.
it's worth its weight, I'll tell you, because we've earned these grays. We've
It's true.
earned the silver. We've been through the ringer quite a few times, so we've learned a
Yeah.
lot of lessons.
Yeah, it's true. It's absolutely true. And speaking of that, I think we're going through a super interesting market cycle phenomenon right now that we're going to talk about today, which is um, what did we call that? Can that
Uh,
be? Oh God, we both lost the word.
well, so I'll just tell you the phenomenon that we're going to talk about, and then we can name it whatever we want. Um, it's essentially when the market becomes overextended from a valuation perspective. We have a lot of momentum on the upside, and the market leadership, meaning the stocks that are kind of leading the way in the returns, are continuing to do it, but it's becoming narrower and narrow. Fewer and fewer stocks are actually participating in that market appreciation. Whereas you start to see also quite a few start to drop at the bottom. So one of the things that we were talking about earlier is, anytime you have a news announcement or an earnings release or anything like that, you have an investor should be pretty skeptical about future returns a little bit when you see stocks doing really, really well. Like their earnings announcements are great. They do that, and the stock price goes up just a little bit. Okay, just a
Mhm.
little bit, 1 or 2%. Okay. And then you have stocks that barely miss analyst expectations and they get crushed. They're down 10, 15, 20% in market value simply because they missed just a little bit less than the analyst expectations. That dispersion, that disparity between the news flow is something that you have to be very careful of, because as you have the leadership narrowing, you have this what we call um, dispersed market internals, in that trading, it becomes a stage, becomes a context, a stage is set for a market pullback to happen, not only in the broader markets, but also in the leadership. So once the leadership starts to crack down or to break down a little bit, then you typically will see, a pullback to a correction, before it resets to go to
So
higher highs.
yeah, and so let's define a couple of those terms a little bit.
Sure.
So talking about last year, we talked almost ad nauseum about, the Magnificent Eight, top eight stocks in the S&P 500 that were really leading the way. And so there were, a good 7, 8, right? Stocks. Alphabet is in there twice because it's two different ticker symbols, right?
That's
Um,
correct.
so technically
Yeah.
it's 7, 8, that's why there's that disparity. Um, but what we're seeing now is that it seems like we're seeing even more concentration. And so like less, even those stocks that were in the top 8 last year are not necessarily in the top 8 this year. And if any of those have any earnings miss. So this is exactly what we're talking about. Say the stock that was, fourth or fifth on the list last year, and they were, really up, gosh, a lot. Some of them were up 20, 30, 40% last year, right? If they have any wiggle on their earnings call, anything that even says, you know what, we're reducing guide, we're still going to grow, but we think we're going to grow a little slower. That's where investors are like, nope, get it out of there. And that's what you're saying. We're seeing like 10, 15, 20% pullbacks just from companies that were really, really going gangbusters last year, not hitting perfectly. And so that's when we talk about dispersion, good news gets you a teeny tiny lift. Even the hint of bad news gets you like plummeting. So that's where it's not equal. It's not a little bit of
That's
good
the
news.
metric.
Right. Yeah. A little bit of good news gets you a little bit of lift. A little bit of bad news gets you a little bit of lowering. Right. No, it's the teeter totter is weighted on the negative side, so to speak.
Exactly. Exactly. And to your point, it was the Magnificent Eight last year, and now it's the Fab Four,
Mm,
right? So we cut it in
yeah.
half,
Yeah.
right? So now we have the Fabulous Four, which are really leading the market. The S&P, the capitalization weighted S&P 500, which is again the S&P 500 that we all hear about. It's the returns that are always advertised. Is up 11% year to date. Great. The S&P 500, same index, all we're doing is weighting it equally now between every position, is up less than 4.
Mm.
So that again, this happened in 2023. We did talk about it at nauseum, but that disparity is growing even more. And that's because the top Fabulous Four are growing quite rapidly, and kind of everything else is not. Everything else is doing okay. I mean, we're only through it's the last day in May, so, or one of the last days in May, and we're up almost 4%. So we're kind of on track for an average year for most of the S&P 500 stocks. But again, those very heavily weighted capitalization weights can really influence one way or the other. So right now it's influencing on the upside. My guess is eventually it's going to influence it too much on the downside.
Mm.
And that's where clients, I hope, are not going to get kind of double whammied.
So one of the examples that we were talking about is I was reviewing a new client portfolio. Um, Recently, it's the money is elsewhere, and we do that a lot, right? Like, okay, where is stuff right now? Let's do kind of a portfolio X-ray to see what's actually in the portfolio. And there were a good 10 different mutual funds. And when you look at the names, you're like, oh, those are different. right? They have different names. Some of them say large cap growth, some of them say, market leader, some of them say global something or other, right? So you've got all these different names on these different mutual funds. Well, you go in and literally all of them are exactly the same. And we know that because, when I'm looking at this overview, 90% of the portfolio was large cap growth. What is large cap growth? Large cap growth is the top of the S&P 500.
Yep.
And
It's all technology and technology adjacent stocks.
yeah, and that's truly what it was. So if we look at the Fab 4 that are at the top right now, that's the majority of all 10 of these different mutual funds that have different names that you would expect are giving you more diversification because you got different stuff in there, right? So the looking at that, my instinct is like, oh God, no, we can't leave it like this because everything is the same. Everything is the same. If the market takes a hit, if large cap growth, that one sector takes a hit, that's the whole entire portfolio is hinged on that. So from your perspective, and I say that because that's not uncommon.
No, it's
That's
actually very, very common.
yeah. And so from your perspective on the CFA side, on the investor side, so I'm on the planning side, I'm looking at that and saying, clearly this is not diversified. And we need to have a discussion around that, the safety of that portfolio. From your seat, what do you say? What do you tell clients when you see that?
Well,
Especially given the environment we have right now.
yeah. So given the environment, as I look at it from a multiple different viewpoints. Okay. So not only do I look at, asset class, sub asset class, sector analysis, but I also look at it from a risk factor standpoint. And risk factor to what you're discussing is technology. Okay. That artificial intelligence innovation wave that a lot of technology adjacent companies have been kind of riding higher, at least up until now. So if that factor, so the way you do an analysis is, what if that factor turns around, even in the short term? What happens? It may continue to grow for years and years and years, but what if it happens to take a pause and come back down? What is going to happen? Well, it's probably going to be a pretty aggressive pullback. And so how are all of those positions influenced if that one factor changes direction and goes the other way in the short term? And once we determine that impact, then we can go through and say, okay, we need to not have as much in this one area. Let's start moving it into some other areas that maybe are kind of beaten up right now. They're kind of cheaper right now relative to their earnings going forward. And once you start to place money in those areas, then you can start to see a little bit more diversification, a little bit more less risk on the downside if that factor turns around.
So one thing I would love for you to share, if you can, the screenshot that you shared earlier about where inflows are going right now, because this really ties in that same way. So when large cap growth is what we're talking about right now, or even like mega cap large cap growth, right? This is like that's really the heaviest um concentration that I'm seeing for most people. It's that people are actually like actively selling off some of these other areas that have been more beaten up, right? Or haven't had as high of returns, and chasing after the returns in these, top 4 stocks.
Yeah, so this is just some analysis and an illustration put together by Arbor Data Science, and this is just a weekly fund flows. And so this is an example of what's happening, and what's been happening for the past couple of years is everything to the left. These bar charts to the left that have a negative number next to it are basically investors selling these assets. Okay.
And so that's so cyclical sectors, non-cyclical sectors, US small cap, all negative outflows. Investment
Yep.
grade bonds.
Municipal bonds, precious metals, government bonds, and inflation protected bonds. And what's been going up is just a little bit in mid cap, a little bit in broad US equities, massive amount in large cap, a little over $8 billion in 1 week. And then just a little bit in the aggregate bond index of 1.3 billion. So you can see that this large cap number is predominantly it is predominantly technology and technology adjacent sectors, which are garnering the most assets coming in, those fund flows. And that's really critical to understand is if this has been going on for a while, which it has been, it's a great way to drive those current returns. However, at a certain point, there's going to be saturation. And at saturation point, what's going to happen is prices are going to be bid up to a point where it's just too high and they're going to turn back around. Now, until that time, you want to ride that trend as long as you can, right? Because you never know when it's going to turn around. That's the crux of the matter is you definitely don't want to be selling these stocks right now. Okay. You want to wait for those markets to start to crack, that leadership to start to go negative, to start to change in any way. That's when you want to start stepping off that bandwagon a little bit and getting that more diversification into other sectors, other areas, which have been beaten up. John Maynard Keynes is often quoted of saying the market can stay irrational longer than you can stay solvent, and that is a great thing. Similarly, in Alan Greenspan, I believe it was 1996, he said he made his famous quote, irrational exuberance, when talking about equity prices. Well, today, looking back from 1996, you're like, that would have been a great time to buy. Even though the Federal Reserve's chairman at the time, Alan Greenspan, arguably a very, very good economist, said at the time it was irrational exuberance in the equity markets. So it just depends on the time period, but also you have to look at it. If you're looking at it from a shorter term perspective, 1 to 3 years, then you have to get a little more diversification when these bandwagons stop to take a rest.
Yeah. So that's the things that are like kind of settling in for me as you're talking about this are once again, and pointing back to something that when we do comprehensive planning, when we talk with clients, when we talk about investment strategy overall, we are constantly looking at time frames, right? That's really one of the keystone factors of a financial plan for an investment plan anyway, right? Or like what are your time frames that we need to be planning for what's coming up? I, you know, I have seen, I don't have clients that I've experienced this with in a long time, which is great, which means that they're awesome clients and great listeners.
Right.
But in the past, I had experienced people who did not want to have anything in bonds or anything that was, lower return. Um, and then would also, every couple of years want to have a big distribution to pay for something. And those two things are what don't go together, right?
Right.
We have to be able to plan a little bit further ahead, or else if you're a spontaneous person and you like, sometimes I just want to buy a house. Okay, that's fine. We just need to know that and be able to keep the right pool of safety for you so that you have that fund where you can go buy a house or go, take your family on a big vacation, or, if you need to take 50 or $100,000 out of the portfolio, we want to have safety for you versus the, what we're seeing right now of chasing returns, wanting everything to be invested. And then, all right, what if one of those top four has a really bad day and your whole portfolio sinks 20%? that's rough.
Yeah.
And then we don't want to have to sell at that point in order to get you the cash that you need. We want to have your different buckets to where, you know what, if yeah, you think about some of the stocks that have been around for quite a while now, Apple, Microsoft, et cetera, right? That they were here in the first tech bubble in the early 2000s, and now, where are we now from if you had bought and hold back in 2000, where are you now, right? It's amazing the growth that we've seen, but that's over time. That's over a long period of time. So if you have a bucket in your portfolio that is long term, yes, you can
Yeah.
write it out.
And that's a very long-term perspective, right? That's a 20-year perspective. There
Hmm.
are points in time in those tech stocks lives that they became on the ropes.
Right.
There's a few tech stocks that we talked about a little bit that went from top of the world to bottom of the world and they're back on top of the world. But if you own them during the middle 10 years, you may not be real happy with that return. And if you need to sell during that downturn, that's problematic. So we need to be able to take advantage of that, and just make sure we prepare against that.
Yeah. And so when we talk about, because we've talked about this a few times too, and we've both gotten questions from different clients, and people just asking questions of, well, if the S&P 500 or index investing, right? Like, if that is working and it's growing, why wouldn't I just, like, straight up invest in the S&P 500, or any one of the index funds that you see? Just go there, leave it alone. And as we've talked about before and talking about right now, that's fine if you have a very long time horizon and you're not going to need that money for something specific, or right, it's you have so much money that it really doesn't matter, right? But then in that case, you're not usually just in the S&P 500. But
Right. And that's one of the things is, the popularity of passive investing is fantastic for a lot of it. Okay. Um, the downside to passive investing is when momentum drives up certain risk factors or certain sectors or certain types of companies, it can be driven up to the point where it becomes nonsensical, and you can actually outperform the index by just going from the cap weighted index to the equal weighted index. So just going from one passive to another passive, you can avoid the downtrend, that downturn in that area. You
mm,
can't avoid it. You can manage that downside relative to the cap weighted. It's a very well-known downside to capitalization weighted structures in any type of investment, whether it be an exchange traded fund or a mutual fund or the like. So it's something that when things get very heated, very overheated, you want to be worried about the capitalization weighted construction of the index. Whether it's the S&P 500 or something else.
can you speak a little bit to the philosophy that we use at Juncture then? Because that's one of the things that I really appreciate. Um, that you were saying, we're not necessarily looking at, not that we're not looking at, but we're not relying as heavily on the technical analysis right now, but more like really looking at fundamentals.
Yeah. So one of the things that I think, uh, in a momentum driven markets, one of the things that you need to do is still ride that momentum up a little bit, but you need to start looking at other factors which may be more important over the next 5 years. The last 5 years has been very, very momentum driven, um, because of this technology wave, this innovation wave, which is great. But eventually it's in my forecast, it's going to do a blow off. It's going to get to the point where it becomes so speculative that its future returns relative to those earnings are going to be pretty poor. Um, the company, now I'm talking about the company share price, not the technology itself, which will proliferate across the global economy. Okay. So much like the internet, right? The internet, you had this really quickly growing area of technology. The internet came about. The stocks became so overvalued relative to their earnings that they came down in price quite a bit for about a 15-year period
Mm.
before they broke even again. Now, did the internet stop growing during that time? No, it expanded exponentially during that time. So I'm not talking about the technology. What I'm talking about is the companies that facilitate that innovation. Okay. So my guess is eventually this is going to slow back down. We're going to have a speculative bubble pop, and those companies are going to, in price, share price, are going to come back down to more reasonable levels. Not, I mean, not dramatic. I mean, not, it's not, it won't be a disaster. That's all I'm saying is they'll come down a little bit to more reasonable valuations, and other areas of the market will, on a relative basis, start to look much, much better.
Mm.
One of the things that I think people have talked about is, you know, there are certain stocks, certain types of companies that they've sold, even though they're really good, they're pretty decent because they're not growing fast enough.
Mm. Yeah.
And that's when you start to see that logic. Well, it's not growing as fast as XYZ. So I'm going to sell ABC, even though it pays a 4% dividend. It's growing its earnings at a pretty nice clip. And it has done so for a long period of time. It's not growing as fast as ABC stock over here, which is involved in artificial intelligence, right? And so you start to see those trade-offs occur. And that's when no one else is going to buy that stock, that ABC stock, because it's bid up so much. There's no other buyers because everybody already owns it. That's when you start having to worry about a little bit about what's going to happen to that leadership going forward. Right now, so far we have two of the three conditions in place for something like that. You know, a narrowing breadth in market leadership. You have a dispersion amongst the market leaders. You know, you have some that are hitting new lows, you have some that are hitting new highs, and when that ratio flips, then the market can come back pretty quickly into a correction.
Mm.
You know, we had a 5.5% correction in April. I would expect a probably 5.5 to 10% at some point in time this year. Um, who knows when, but it could happen. So it's one of the things that I think people have gotten used to, not necessarily as much volatility as we saw in 2022,
Mm.
but they've become accustomed to low volatility, and that's just not the reality of the equity markets.
Yeah. Yeah. There's maybe next time we can share some of those. There's the scatter plot graphs. I love those that show, what throughout the whole year. Here's where we were every day, up, down. And you can see even in a year where, we might end up with 14% positive, have a great year in the markets overall. There was, usually a time where we were down 6 to 10% or more in that exact same year.
Yep.
And that doesn't feel good, but we get to like see the whole thing. So let's put that
Yeah.
on the radar for next time. Talk
Will
about
do.
how returns actually happen throughout the year and what it feels like on a micro, when you zoom in. I think that speaks to what you were saying too. Even these, market leaders now that everybody owns in, all of the most popular mutual funds and ETFs, they had times over their lifetime where they were down 20, 30, 40, 50% from their recent highs, right? They've experienced real volatility when you zoom in on a certain year, but when you zoom out into the 10, 20 year time frame, the graph looks a lot smoother.
Exactly. That's exactly right. That's why we say time, as you lengthen your time horizon, the volatility goes down.
Mm-hmm.
Okay. Which to a lot of people doesn't make any sense. However, if you think about it, 10% on a million's 10%, right? And the longer you have it, the more profits you have in it. So the less volatility you're going to have in it. So from a profitability standpoint. So it's just one of those things that from an individual in a household perspective, you're not tied to every 3 months your return. So you can use volatility against people who cannot tolerate volatility. And right now I have a very large account that we're averaging into the market because they have a lot of cash. And we're taking pretty long steps in between these investments. The reason why is because we're at pretty close to all-time highs.
Mm-hmm.
And I want to allow the natural course of the summer and of the US market equity markets for the volatility. I want to give it the opportunity to have that pullback and buy some of those shares at cheaper and better entry spots. Now, I'm not saying that I think the economy's trashed and the equity markets are going to fall apart. I don't think that, but I do think that people have become very accustomed to a straight line up, and that is not what usually happens in equity markets. Every once in a while, we get this hey, everything's great and it's the markets are growing up in a straight line, and people start to think that that is how equity markets usually behave, and that just isn't the case.
We're out here challenging the recency bias as much as we can, right?
We try. We fail, I think, sometimes, but
Well, it is what it is, but at least we talk about it. So, well, I think that is an awesome place to wrap up for today. Thank you, as always, Brad, for coming on and sharing this time with me. And if anyone has any questions, know that we love to receive those from you. You can get me at Hannah, HANNAH, at expansiveceo.com. Just put podcast question in the headline. We would love to receive that from you. And Brad, how can people get a hold of you?
you can get a hold of me at my phone number, which is 480-253-4100, or you can email me at bhaines, BHAINES, at juncturewealth.com.
All right. Thanks, Brad. We will catch you next week. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.